Okay, delinquent FHA mortgages soar by record 60% to an all-time high. That's what we're going to talk about today. Welcome to Housing Bubble 2.0 News of the Week, or as I like to always call it, another episode of As the Housing Market Turns. I'm Randy Patrick, your host, putting the realism back in real estate. All right, and just a quick note here. A lot of people have texted me or emailed me or messaged me about lack of videos these days. And I guess a couple of reasons. Number one, I'm busy. I'm out in the field quite a bit looking at properties and working on deals. That's number one. So yes, even in this pandemic and low inventory, if you know what you're doing and you're looking for deals, you can find stuff out there. A lot of my stuff is off market. As well, I guess you could say I'm kind of satisfied where we are with respect to the housing industry. And a lot of the analysis I've done, the people I've spoken to, I'm pretty, happy and pretty, I guess you could say, resolved as to where the housing market's going to go. And I'm preparing to work with all the changes we're going to see the next few months. So that's sort of the reason why. But yeah, I guess I could probably do a few more videos here and there. And I'm going to start doing that because now we're starting to get into some really little more information, a little more interesting information that's going to affect kind of how things are going to play out as time goes on. So anyway, just one thing, if you're not already a subscriber, if you could do me a favor and please subscribe to my channel and help it grow, I would really appreciate that. So thank you. All right, guys, let's move on to the new scene here. And so the news that's kind of dominating, I guess, sort of the housing news wires is basically the fact that, CoreLogic put out some data the other week about, I guess you could say, loans and where things are at. And basically boils down to, the mortgage delinquencies are really kind of starting to stack up now. And they are increasing. And it's to be expected because we have people that are in massive financial difficulty, forbearance, a lot of stuff going on with people. So yeah, you're going to see as a result of this, we're going to see mortgage delinquencies, increasing as the months go on. Particularly, though, I guess the real news is that FHA, Federal Housing Administration, so they back the mortgages and or back certain mortgages. They buy them, resell them in the open market. They guarantee them, and that segment is really, I guess you could say, taking a beating with respect to the delinquencies that are hitting. So, and as you can see here, the economy is being rattled. So yeah, I mean, it's going to start to manifest itself as time goes on. This, that was from National Mortgage News. This is basically from Zero Hedge. When you take a look at the information, what people are talking about here, we've got soaring, I guess you could say, the share of delinquent FHA loans, is rose to 15.7% in the second quarter, up a whopping 60% from about 9.7% in the previous 3 months, and the highest level on record dating back to 1979. So that's kind of the situation that we're at here. So when you go back a number of years ago, a number of decades ago, the 30-day, like the current to 30-day transition rate, you can see that we're bumping up. And the problem is that when we bump up with respect to what's a current mortgage and what's going into delinquency, which is late, essentially 30 days late, is that we're going up on an exponential level here. It's not like a little bump and it slows down. It basically is bang. We have this huge jump because we have people who were already facing financial difficulty prior to COVID, prior to the shutdown. And now we're seeing the effects of people who are saying, I can't pay my mortgage, whether they're not paying and they're becoming delinquent or they're jumping into forbearance plans. Either way, we're seeing a significant increase in what's going on. From Bloomberg, obviously, FHA mortgage delinquencies reach a record, and there are certain locations across the U.S. that are more susceptible to delinquencies, financial issues, high taxation with respect to real estate taxes, personal income tax, situations with respect to what's going on in that state's economy. New Jersey is leading the area or the state with the most FHA delinquent mortgages. So according to Bloomberg there, which is off from the MBA, Mortgage Bankers Association, the share of late FHA loans rose to almost 16% in the second quarter, up from about 9.7% in the previous 3 months, and the highest levels record dating back to 79, which we talked about. Basic delinquency rate for conventional loans by comparison was 6.7%. So we can see that, whatever it is, government-backed loans tend to have higher delinquency rates. Are there reasons for that? Were their lending standards lower? Did they allow for greater debt-to-income ratio? Do people have less money because these type of loans, these FHA loans allow 3.5% down payment? So are we as low interest rates helping to stretch where people can purchase, and maybe they're overbuying or they're taking themselves out of their comfort range? A lot of reasons why this could be happening. You can be the judge of that here. Interesting, though, I find that New Jersey had the highest delinquency rate at 20%. All right. The state also had the biggest increase in the overall late payment rate, jumping to 11% in the second quarter from 4.7%. Pretty significant jump with respect to all the mortgages in that state. Following were Nevada, New York, Florida, and Hawaii, all states with a high proportion of leisure and hospitality jobs that were especially hard hit by the pandemic, the MBA said. Now, here's a little comment I want to make here. I do have, sometimes I do read the comments, not often these days, but, a lot of people were saying, well, we have all these these issues, et cetera, and we're not going to have mortgage problems because all these people that are losing their jobs, they're the renters out there. They're not the ones that are paying mortgages. So therefore, guess what? We don't see this, the pandemic and forbearance being a problem, for the housing industry. Well, I kind of disagree here, and that this says it right here. So people who were saying that it's just the renters that are having difficulty in losing their jobs, well, guess what? When we've got Mortgage Bankers Association basically saying here, hey, Nevada, New York, Florida, and Hawaii, there's going to be a high proportion of leisure and hospitality jobs, but maybe those people do own properties, and maybe those people are the ones that are fitting into the FHA demographic of who are taking out loans. So you can't just go on and say just because the pandemic is only affecting the renters and therefore housing industry is going to be fine. All right, this kind of debunks that statement right there. Again, this is from the Mortgage Bankers Association actual website. All right, delinquency rate for mortgage loans on 1 to 4 unit residential properties increased to a seasonally adjusted rate of 8.22% for all loans outstanding at the end of the second quarter of 2020. So that's the end of June 2020. So they've summarized it over the second quarter. All right, realize that July is already gone, and we're halfway, just past halfway point in August. So clearly there's going to be more delinquencies, and there's going to be some adjustment in the forbearance numbers and things like that. But this is they're looking at the end of the second quarter. Realize that, please. We got to go down here. Okay. The delinquency rate increased 386 basis points from the first quarter and was up 369 basis points from 1 year ago. For the purpose of the survey, MBA, Mortgage Bankers Association, asked servicers to report loans and forbearance as delinquent if the payment was not made based on the original terms of the mortgage. So part of the delinquencies are going to be in the forbearance numbers as well too. So basically what we're seeing here though is that the concern is when things move to what's called later stage delinquencies. So when you're going from 30 days delinquent to 60, when you're going from 60 to 90 days, the farther delinquent you are, the less chance of recovery. That number one, you can recover on your own, and two, that you can recover with some help. So that's the concern here. So, for me, when I look at that number, I'm going, that's a pretty big number, 16% for FHA borrowers for sure. But this is really interesting because when we're looking at some of the results here, well, it's the 90-day delinquency is climbing to its highest level since the third quarter of 2010. That's sort of right back in the housing crisis. Okay. Now it said 30-day delinquencies did drop in the second quarter, which is an indication that the flood of new delinquencies may be dissipating. Right. Well, again, we're going back in time. We're going back to the end of June. So maybe that information is great, but what happened at the end of July? The stimulus checks stopped. All right. So again, because we're in that, the information for delinquencies and mortgages, kind of like home values as well too with Shiller, we're usually 1 to 2 months in lag time. We don't know the effect that the lack of stimulus checks or the lack of unemployment number support is going to have on this as well too. So as much as the 30 days maybe dropped a bit, I foresee that picking up once we can catch up on some data here. All right. So again, they're saying the 5 states with the largest quarterly increases in delinquency rates are New Jersey, Nevada, New York, Florida, and Hawaii. And again, same thing with the hospitality jobs. That's what they're stating here. Key findings, again, 60-day delinquency rate increased 138 basis points, the highest rate since 1979. So people going from the 30 to 60 day, and then the 90 day we said jumped up again, the highest rate since the third quarter. When we take a look at overall loan types, FHA delinquency rate increased 596 basis points to almost 16%. The VA delinquency rate increased to over 8%. And on a year-over-year basis, total mortgage delinquencies increased for all loans outstanding. The delinquency rate increased by 307 basis points for conventional loans. Again, you can take a look at that there. So the point is, all segments are increasing. Certain loan, we'll call servicers or loan backers, VA, FHA, are getting hit harder. As I said earlier, is that because of different standards? Conventional loans, conventional lenders, private label lenders tend to have higher standards than government-backed loans, than FHA and VA. And again, with respect to the lower interest rates, lower down payment, we have talked previously, months ago, about the changing in debt-to-income ratios. Realize that the government-backed loans here have something called the QM patch. QM stands for qualified mortgage, and the QM patch was basically an alleviation of some of the debt-to-income ratio standards that were out there. So essentially, it's allowing lenders to have higher debt-to-income ratio standards or levels when they go into their FHA-backed mortgages, which now, again, that means more of your income is being assigned to your housing costs, which can cause you some situations if you're losing income or having income, loss or shutdowns or reduction hours, furloughed, whatever. You're more susceptible to having mortgage problems if the greater amount of income is being used for housing expenses. So that's the situation we're in, and we know that was part of the FHA and VA loans. They were allowing higher levels of debt to income ratio. So again, going back to same thing, the 5 states, and really, we're looking back at June 28th here, end of the month. There was 4.2 million homeowners in the forbearance plans. We're roughly hovering around that 3.9 to 4 million number of people who were in forbearance. All right, this is from Wolf Street. I do always like his take on what's going on here and just some of the comments he makes. So as you can see, the headline, again, this is the same headline. Mortgage delinquencies jump by most ever. 60-day delinquencies hit the highest level. Record, what a mess. Includes mortgages already delinquent before they were swept under the big federal rug of extend and pretend forbearance programs. All right. Interesting. So it says the forbearance mess keeps on getting messier. Record low mortgage rates continue to push certain other segments of the housing industry towards ever greater exuberance, which we know. And when you take a look at it, the overall delinquency by June 30th is reaching 8.22%. It's a 4 percentage point jump, which is a lot, and that's going back to 79 with when they were doing the surveys. That's the largest jump. We can see that 30-day delinquencies, I mentioned, went down a little bit. 30 days are up. 90 days are up as well too, and they're being compared to back in how many decades ago and the housing crisis. So that's a situation we're looking at right there. Let's go one more slide here. FHA's up to almost 16%. VA, conventional. This is interesting though. I said the delinquency rates here include mortgages that were already at least 1 month delinquent before they entered into the forbearance program. So these mortgages are still delinquent, and the borrower has stopped making payments before entering into forbearance. But the lender has agreed not to pursue its legal rights for the agreed upon period of forbearance. So you could have already been delinquent, is what they're saying, by a month or two, and then you opted into forbearance, and you got some of the forbearance coverage. So instead of the borrower either catching up or the mortgage going into foreclosure, the mortgage is put on ice during forbearance. The borrower doesn't need to make payments. The lender, after putting the delinquent mortgage into forbearance, may no longer consider the mortgage delinquent and may therefore show still the mortgages as performing and may still show interest income from it, although no one is making payments. So that's where some of the numbers can be kind of fudged and moved around. My issue is that we're never really going to know the true number of what is in forbearance, who is delinquent, etc. There's no, I guess you could say, we'll say one place to report the information. Servicers don't have to report that information. It's their own private information, right? Banks, lenders, servicing companies don't have to report to anybody. The NBA goes out, not the NBA, the MBA, not mortgage bikers, Mortgage Bankers Association. They're doing the best they can, but they're only getting information from X number of people who respond, the servicing companies. CoreLogic, same thing. They're getting probably 80% of the information, and I can tell that probably the servicing companies that are getting hit the most may not want to show people publicly where they're at with respect to forbearance and delinquencies and defaults. So people don't want to show that information right now, especially where we are in the timing of an election year, of the market, the whole bit. We still want to run the high as to what's going on. So again, if you take a look at the percentage of mortgages in the last 30 days that are past due, the 10 largest metropolitan areas, I look at this as just like the last housing crisis, guys. Miami, look at it, almost 14%. New York, about 12%. Vegas, over 10%. Houston, over 10%. Chicago, around the 8. Washington, 8, probably 8, just under 8%. LA, getting up there. Boston, Denver, San Francisco. So, and again, this is going back to May, all right? This is, May information reported in June. So, as I said, from CoreLogic here, so not, we're a couple months off here. So my expectation is that where we are today, and again, tag along, drag along information, is that we're going to see this being, larger default, larger delinquencies out there. There's no ifs, ands, or buts. This is what's happening, guys. When you take a look at forbearance and defaults and delinquencies, I can tell you from past experience what happened last housing crisis, how homeowners and mortgage clients were treated, and how stuff didn't work for them, programs didn't work for them. If we've got 4 million plus, 4 million on average people in forbearance, all those people in forbearance aren't magically going to become current on their loans, and everything's going to be made whole or good by their lenders. It just doesn't work that way. All right, there are restrictions on how things can be packaged and how, I guess you could say, loans can be modified and where payments can go and stuff like that. So there's restrictions based on loan pools and all that, and how they're set up on their tranches and things like that. So it's just not as easy as waving the magic wand and everybody who is not paying all their missed payments go to the back of the loan. We're just going to extend the loan, things like that. Also realize that it's predicated also on the fact that when your forbearance is over, you need to start making your normal mortgage payments. And if you still can't do that, then you will continue to fall in the default, and the foreclosure process will start. So, in my humble opinion, 4 million that we're talking about forbearance. Okay, that's the number that we always think about. We're not even including the number, which we don't know really, of we'll say delinquent mortgages that aren't in any forbearance program. Okay, so there's that number there, which is, I'll call the wild card number. So we don't know what that is, but they're out there. So people who are, we're going to see more and more of this as time goes on. That's all I'm trying to say to you. So how does this affect the marketplace? Straightforward. Eventually, these people can't be serviced by the banks, lenders, and servicing companies. They will fall into the foreclosure process. They will need short sales to help them, which is a great opportunity here. If not, they're going to stay in their property for as long as they can. Some will declare bankruptcy. Some may get lawyers to help them with foreclosure defense. The majority will end up losing their homes at auction to third-party bidders, or will be taken back by the lender into the lender's REO inventory. That's what will happen. We will see this in waves, all right? Once the eviction and foreclosure eviction moratorium gets lifted, I know some states we have that lifted now. Some are getting there. I know for us, where I am, it's the end of the month for this month. So when that stuff is lifted and it's not reset again, we're going to start to see the waves of the foreclosures getting reset and starting to hit the auction block. So that's going to be our first mini wave of, you should say, distress happening. So get prepared for that. Be prepared for it. Start looking at real estate. Start looking at how to either buy at the auction, how to do short sales, how to figure this stuff out. Because I tell you, this is how it's all going to start. It's going to happen in a couple little waves here. So that's, again, all I wanted to show people is that, the numbers that we're seeing are, it's happening like the last housing crisis. It's compressed into a smaller time frame, and we've got other situations that are impacting how the market's going to play out. So yeah, with low inventory, and we can see continued prices rising right now, but when this stuff starts hitting, we'll see some changes. You should be prepared to work with those changes when they get here. All right, everybody. I'm Randy Patrick. Thanks once again for the views, likes, comments. Please reach out to me if you want to learn about what I've talked about. I can show you what to do, how to mess with the marketplace, and how to get lower priced property. It's going to happen, guys. I'm very confident that this is where we're going, and this is what we should all be looking forward to. Yes, it's taking longer to get there, or maybe we're just a little impatient because we see and talk about this every day because of the the readily available information and statistics, etc., etc. So anyway, guys, take care. We'll look forward to speaking with you in the next little while.